Greetings from Aaron Layman Properties. This is an update on the Denton County North Texas housing market. Denton County continued its correction in October. Home closings fell 22% year over year. Pending sales were down by a similar amount. The housing market reset continues to take shape across North Texas as inflated home prices crumble under the weight of the Federal Reserve's tightening cycle. 6 and 7% mortgage rates have proven to be too much for a housing market that ran up too far too fast during the pandemic. Median home prices in Denton County continue to cool. Home prices are down about $45,000 from the spring peak this year if you're looking at the median. Average prices are down about $55,000 from the highs earlier in the spring. While nominal prices have actually rebounded slightly in October, the real price per square foot continues to fall. Buyers have been getting a little more home for their money as this housing reset takes shape. That's probably welcome news for some of those shopping in the market. Sellers continue to get hit with the Fed's demand crush as lofty expectations of record spring prices fail to materialize. Median and average percent of list price are still falling off a cliff in North Texas. The median Denton County home sold for 97.3% of original list in October. The average percent of list fell to 96%. Days on market continue to spike with the recent demand crush as well. It's now taking more than a month on average to sell a Denton County home. Good homes are still selling relatively quickly, but sellers are being punished for deferred maintenance or a lack of motivation. Phoning it in is no longer an acceptable marketing strategy. I'm still seeing some delusional overpriced listings, but there is some normality finally returning to the market. Available home inventory continues to rise. That's something you wouldn't typically see with a normal seasonal pattern. Denton County inventory stood at 2.6 months of supply in October. New home supply is holding above 5 months as builders remain coy about lowering their inflated profit margins or the price of new homes in the area. The price cuts continue at the margins, but there has been no real capitulation yet by most builders. Arlington-based D.R. Horton reported net income of $1.6 billion in its fiscal fourth quarter, with a 6% rise in home closings. Horton's net income was 22% higher than the same quarter a year ago. D.R. Horton was so flush with cash they repurchased $251 million in stock, bringing the total for share buybacks in fiscal 2022 to $1.1 billion. Nothing like a little financialization to pad executive comp. The coming months should bring a little more motivation from builders as contract cancellations continue to pile up. Greed has its limits, and buyers are finally stepping back from the market with affordability out of reach. D.R. Horton's net sales orders for the fourth quarter fell 15% year over year. Horton's cancellation rate spiked to 32% in the fourth quarter. That would explain the spike in new construction listings we've seen in the past few weeks and the price cuts on many of the new homes sitting on the market. There's still a huge backlog of new construction set to hit the market in the first half of 2023. D.R. Horton is just the latest builder to report a big spike in cancellations and collapsing orders as falling demand weighs on the housing market. The reason is pretty simple. With mortgage rates still double where they were last year, home prices are still too expensive. Affordability has been crushed, and the monthly payments just don't make sense for many prospective buyers. October's better than expected CPI inflation numbers showed a year-over-year headline inflation at 7.7%. The shelter components for CPI posted the highest readings in the cycle. The lagged CPI indicators are finally beginning to cool a bit, but the shelter and housing components of CPI will help to keep those readings elevated for the months to come. The stock market and the mortgage market celebrated the relief on the inflation front, but there's a long way to go before the Fed gets anywhere near their 2% inflation target. The road ahead for the housing market will remain challenging because the demand destruction is already set in motion by the Fed, and that will continue for longer than many are anticipating. It's important to remember that real quantitative tightening didn't really start until September. We may only see a few more rate hikes from the Fed, but they've been pretty clear about that they have no intention of lowering rates anytime soon. The Fed's bloated balance sheet is only beginning to unwind. It will be another year or more before the Fed can say they have made any progress on this front. Prospective buyers hoping for 4 or 5% mortgage rates anytime soon should temper their expectations. Higher for longer remains the theme in terms of rates. 6% rates are certainly better than 7%, so buyers will likely take whatever relief the market provides. Carpe diem, as they say. The Denton County housing market is holding up pretty well considering the circumstances. Average home prices in Collin County are already down $90,000 from their spring peak. Submarkets like Frisco, Prosper, and Salina have seen average prices plummet as much as $170,000 from their bubble tops earlier this year. Across the Dallas-Fort Worth market, the story remains the same. The further prices were detached from historical trend, the sharper the correction. All markets are local, but they're also interconnected. Liquidity was and is the key to this housing market run-up, and it will be the key to the correction. As long as the Federal Reserve is draining liquidity from the system, you can expect more volatility in the North Texas housing market. This is Aaron Layman Properties. Thanks for tuning in.